Mark-to-market, or MTM, accounting is a concept that has stirred debate across industries, from financial services to manufacturing. Originally designed to provide transparency in valuing assets and liabilities, MTM accounting reflects current market conditions, aligning a company's financial statements with prevailing market prices. While this method is vital for certain sectors, its applicability in manufacturing and distribution raises critical questions, particularly when applied by a company like Nvidia, whose core operations involve physical goods. As Nvidia prepares to release its earnings report tomorrow, the use of MTM accounting deserves closer scrutiny. Why would a manufacturing and distribution giant employ a method typically suited to financial or software firms? This article explores the intricacies of mark-to-market accounting, its benefits and pitfalls, and why Nvidia's reliance on this method may not be the best fit for a company in its sector. Mark-to-market accounting, also known as fair value accounting, involves recording the value of assets and liabilities based on their current market price, rather than their historical cost. This approach ensures that financial statements provide an up-to-date snapshot of a company's financial health. For example, in financial markets, MTM is used to value securities, derivatives, and other financial instruments that fluctuate daily. In other industries, MTM might be applied to inventory, real estate, or even intellectual property, where current valuations are deemed critical to investors. The aim is to provide stakeholders with real-time insights into a company's financial position. Yet, this method can create volatility in earnings, particularly in industries where market values are subject to significant fluctuations or are challenging to determine accurately. Nvidia, a global leader in GPUs and AI hardware, operates primarily in manufacturing and distribution. Unlike software companies or financial institutions, Nvidia's revenue stems largely from the production and sale of physical goods. These tangible products have fixed costs, raw materials, labor, and logistics that are more aligned with historical cost accounting. The adoption of mark-to-market accounting for a company like Nvidia raises questions. MTM accounting could assign a fluctuating value to Nvidia's inventory based on market demand. The semiconductor industry is inherently cyclical, with demand for GPUs and chips fluctuating due to broader economic conditions, technological advancements, and geopolitical factors. MTM accounting amplifies these cycles, presenting Nvidia as more volatile than it may truly be. MTM accounting is a natural fit for software companies with high-margin, intangible assets whose value directly correlates with market trends. Nvidia, by contrast, deals with physical goods whose value is less susceptible to rapid market price shifts. Historical cost accounting might provide a more stable and realistic picture of the company's financial position. By valuing assets at market prices, Nvidia risks sending mixed signals to investors. Historical cost accounting records assets and liabilities at their original purchase price, adjusted for depreciation or amortization. While this method lacks the real-time appeal of MTM, it offers several advantages for manufacturing companies like Nvidia. It reduces earnings volatility, providing a clearer view of long-term financial health. It aligns financial statements with the fixed costs of production and distribution. It eliminates the risk of short-term market swings distorting valuations. By switching to historical cost accounting, Nvidia could present a more consistent and reliable financial narrative, better suited to its operational realities. Nvidia's reliance on MTM accounting underscores a broader trend in the tech sector where traditional hardware manufacturers increasingly adopt practices more common among software or financial firms. This shift raises important questions about investor expectations and whether companies like Nvidia are bending their reporting practices to align with Wall Street's preference for rapid growth and high valuations. It also raises questions about regulatory oversight. Should regulators impose stricter guidelines on the use of MTM accounting in sectors where it creates more noise than clarity? These considerations are particularly relevant as Nvidia continues to blur the lines between hardware and software, positioning itself as a leader in AI ecosystems. As Nvidia prepares to release its earnings report, the use of mark-to-market accounting invites scrutiny. While this method has its merits, its application to a manufacturing and distribution company seems misplaced, adding unnecessary volatility to an already cyclical business. Investors, analysts, and regulators must question whether MTM accounting truly serves Nvidia's stakeholders, or merely creates a more attractive, albeit less accurate, financial picture. For Nvidia and companies like it, the challenge lies in striking a balance between transparency and stability, ensuring that financial reporting reflects not just the market's whims, but the reality of long-term value creation.